So in this video, we're going over a financial portfolio. And a financial portfolio looks something like this, usually in the form of a pie chart. But before we get into some specifics, let's go over the broad generalities of what a portfolio is. So the definition that I'm going to give is that a financial portfolio is how you structure out where you save and invest your money. And one thing to note is the portfolio can be based on any amount of money, whether you have $1,000 or $1 billion or 10 billion. Everybody has a financial portfolio, whether they know it or not. And it's just about where your money is saved and is invested. And it's always percentage based. Make note of that. Get that again. It's always percentage based. You have X amount percent here, here, and here. And again, the main idea or the key of a financial portfolio is that you just know where you are putting your money. It will definitely help you to know where your money is invested and saved at. Everyone has a different portfolio. I'm going to say that again. Everyone has a different portfolio. And let's take a look at some of these examples of ways that you can structure your portfolio. So here's an example of something called a diversified portfolio. And that's the original one we were looking at, where the money and the investments are scattered around to different things. So for example, in this one, let's say you have 20% of your holdings in cash. Then you invest 20% into the S&P 500, 20% into government bonds. And then you have some more specific investments. You got 10% in the QQQ NASDAQ ETF. And then let's say you pick a few specific companies that you think are good bargains. You have 10% into Apple, and then 10% into Google, and 10% into Bitcoin. So this is an example of a diversified portfolio where the money is invested into a bunch of different categories, and these ones tend to be generally safer because if one asset goes really poorly, it doesn't just crush you. Here's another example, and this one is more of an old structured portfolio that our parents and parents' generation would go with, and this was called the 60-40 portfolio, and this is the idea that your investments 60% go to government bonds, and the other 40% went into general stock funds that were usually managed by a third party. And this was a lot more popular in older generations because they were tended to be lower risk, and they didn't have the technology available to monitor all the markets and everything day to day. So usually had a third party manage their money for them, and the third party usually went with the 60-40 portfolio. And again, the goal was just to get about 2 to 5% gains per year. And the goal was really more to not lose with the 60-40 portfolio. But that's a little bit outdated. Now it's more of a diversified, like the first one. That's what most people go with. Here's another example, and this one is a higher risk portfolio. So that would look something like this, where you split your assets up into just a few bets, and you're going 33% on 3 bets. So let's say you have a lot of confidence in Apple. So you go 33% in Apple, you go 33% in Bitcoin, and then 33% in Amazon. So you really are just very confident in these 3 assets, and so you are somewhat going big on them. And again, this is higher risk, higher reward, because if Bitcoin, for example, let's say does very well in the next 5 years, then your high risk portfolio, you're going to be very happy you had 33% on it. But let's say Apple does very poorly over the next 10 years, then it's going to hurt you. And again, it's all just about calculating and managing risk. So high risk portfolios, you should know a lot about the assets you're invested in. And then we can go even one step further, and then there's the all-in portfolio. Not many people would do this. I would not recommend this because you can either get burned or you can have a huge reward. But the all-in portfolio is just when you go all in 100% on one asset. And so, for example, let's say you just have everything into Bitcoin, or you have everything into Apple, or everything into Nike. And again, this I would not recommend because you are all in on it. And so if the asset tanks and goes down like 30-40%, you just lost 30-40% of your money. So that's the all-in portfolio. And then you also have the all cash portfolio. So that's where you're just like, you know what, the markets are too much for me. Also would not recommend this because your cash value will just stay the same. And again, if you make smart safe investments, you can do at least 2 to 5% on average per year. If the higher risk ones are too much for you, I would not recommend all cash, but a lot of people unknowingly do all cash because they don't have any investments. So what they do is they actually are holding an all cash portfolio without realizing it. If you are too risk averse and you don't want to manage anything yourself, this is what I would recommend, is the all managed portfolio. So that would be look something like this. So you hold 10% in cash, and it doesn't even have to be 10%, it could be 20%, 40%, whatever, but the idea is the rest of it that you don't hold in cash, it just, you have a third party manage it for you, like E-Trade or TD Ameritrade, and they just manage the rest of the assets for you, and they would tend to pick safer stock picks, ETFs and stuff that try to get around 5% per year. And again, you're hands off on that, so you don't have to pick anything yourself. You just set up an account and they do it for you. So that's an all managed portfolio. If you don't want to pay attention to any of this stuff yourself, I would recommend this one. So those are just a few different types of portfolios. And remember that everyone has a different portfolio, because everyone's going to have different risk factors, different financial goals and stuff. So everyone's will be different. And so just know that how you structure yours is up to you. And this is what you're going to be doing in the assignment here, is you're going to just, out of 100%, you're going to try to structure your own portfolio. And this thing, portfolios are always changing. So whatever you pick now, it's just, you're doing more for like an idea for the future. So that is the lesson on portfolios. And as always, have a nice day.